1.1 Risk of Death. One of the reasons people delay buying life insurance is that they do not want to think about their own death. They either refuse to consider it at all, or they say that it is too far away in the future to worry about today. But the fact is that everyone is constantly exposed to the risk of death, every day, every minute, every second. The probability of dying today might be much smaller than it will be 40 years from now, but the risk is still very real, and it still needs to be addressed. In insurance terms, the probability of dying at a specific age is referred to as the mortality rate. There are many factors that influence a person's risk of death, including age, gender, family history, health, smoking status, and even their job and income level. Life insurance companies try to classify or categorize people into groups with a similar risk profile. They then compile historical mortality data for each group and use that as a basis for estimating an individual's risk of death. There are two ways of looking at the risk of death: life expectancy and probability of death. Life expectancy is the average number of years that a person within a certain group and of a certain age can expect to live from that age forward. It assumes that the past mortality experience of the group to which that person belongs will hold true in the future. For example, according to data compiled by Statistics Canada, if we consider all males in Canada who are aged 65, the median male within that group will live for another 19.3 years. This means that, on average, 50% of men currently aged 65 will live until age 84.3 or longer, while 50% will die before reaching age 84.3. The probability of death is the statistical probability that a person within a certain group and of a certain age will die before reaching his next birthday. It assumes that the past mortality experience of the group to which that person belongs will hold true in the future. The same Statistics Canada study shows that of all the males in Canada who turned 65 years of age, 1.137 out of every 100 of those men will die before their 66th birthday. In other words, their probability of death is 1.137%. Chapter 9 discusses how insurance companies use this probability of death when they underwrite a life insurance policy and determine the appropriate premiums. Life expectancy and probability of death statistics are compiled for each unique and defined group of people and are often presented in a format called a life table, sometimes also known as a mortality table. With the exception of the first few years of life, an individual's probability of death starts quite low and increases very slowly until around age 40. After age 40, it begins to increase more dramatically year over year due to age-related health problems, such as cardiovascular disease. Gender is another factor that influences an individual's life insurance premiums. A female's risk of death is lower than a male's risk of death at the same age. The way an agent uses this information depends on the specific needs he is trying to address. If he is developing a retirement savings plan or retirement income plan, the focus would be on the client's life expectancy, because it helps determine the appropriate planning horizon. When doing insurance needs analysis, the agent may find it useful to educate a client on his probability of death, to help him understand that the risk is real and that he needs to address it.